Welcome everyone today. My name is Brant Butt. I'm an investment advisor here with Endeavor Wealth Management, and I'm joined by my colleague, Craig White, portfolio manager here at Endeavor Wealth. Craig handles a lot of our research and portfolio construction here at Endeavor, getting into a lot of the nitty-gritty details of all the companies that we own. And as we've come to the end of another quarter, we thought it'd be worthwhile to recap what's occurred in the markets over this quarter and throughout the year, while also highlighting some of the positions that we own and how they've fared through that period. So, with that, thanks for joining me today, Craig. Excited to kind of get into it here today.
Yeah, for sure.
So with that, 2020 been a roller coaster every year as it relates to the markets. We saw a strong finish to the year in 2019 that ultimately carried over into the first couple months. And then, of course, a pandemic hit, and we saw an unprecedented drop in economic activity due to government-induced shutdowns. This resulted in obviously the fastest bear market on record, but as well the fastest recovery on record. So before we get into some of the positions we own, I thought it'd be worthwhile to maybe, if you could shed some light on what's occurred in the markets this year and in this past quarter.
Yeah, I think it's what you said is very correct. It's truly been unprecedented, and I think that's a term that gets overused a lot, but in this case it really does apply. I mean, we saw, because of the pandemic, about a 30% drop in the space of 30 days, pretty much, and never seen anything like that in markets before. And after that, we've seen a pretty unprecedented response. People have, in central banks and in governments, have learned from their 2008 experience, and they really dialed up the quantitative easing and the lending from the government. And of course, there's been huge fiscal stimulus plans, potentially more to come. They're negotiating it right now. So I mean, it's really been quite dramatic, and the impact on markets has been crazy. I mean, but I also think there's been a crazy impact on markets, but there's also been a real divergence, because if you look at some of the top performing names, they might be some of the more high quality tech names, and maybe even some of the more high quality businesses in other areas, like companies like Walmart have done very well, stuff like that. But there's a lot of industries and a lot of companies that are also still suffering quite a bit. And if you look at airlines, or you look at anything travel related, hotels, amusement parks, travel agencies, all of those are obviously hurting really bad. And I think, if we go down to the more Main Street level, small business restaurants, small business retailers, I think there's a lot of suffering still going on. So it's been a real divergence, and I really don't know how that's going to play out for the rest of the year, but I think we're being optimistic, but also very cautious at the same time.
Absolutely. You mentioned that divergence there, and I know often I hear a lot of people talk about how can the markets be doing so good, but when you actually look at it, it is a small number of names that have really propelled the market forward that are leading to those higher numbers. And with that, we can get into some of those stronger names. For several years, our team here at Endeavor, we've been investing fairly heavily into some notable companies in China. Both businesses that are very strong businesses, could be almost considered, they have aspects to technology to them, very strong competitive advantages, as well massive market opportunities over in China. And if you've lived in China, or if you have family members that have lived in China, it's almost 100% certainty that you've used products from these companies, likely multiple products from these companies. And although for the past several years we've seen some gyrations in the share price due to some of the political tensions between the U.S. and China, these businesses over those years and through the pandemic have continued to perform despite those tensions. And so was hoping you could talk. The two businesses that I'm referencing here are obviously Tencent and Alibaba. So I was hoping you could maybe start with Tencent and talk to us a little bit about their business there.
Yeah, absolutely. Tencent's a company that we've owned for a number of years now, and We bought it based on the premise that we were getting a fantastic business, and the price of it was quite reasonable actually. Um, I've witnessed an interview with Charlie Munger, vice chairman of Berkshire Hathaway, where he talked about businesses in China, and he said that he believed that the strongest companies in China were better than the strongest companies in the U.S. And I think he's absolutely correct on that. And I'm not saying that because I think that Tencent has a better product or has better technology or better employees than any of the North American technology companies. But if you look at their size of their number of customers they have, if you look at their growth of their business, if you look at just the breadth of the things that they do, and we have a slide that shows a comparison of North American companies of all the different businesses that they are in. It's unbelievable the amount of influence that Tencent has over the daily lives of a person in China, and that just gives them huge control.
Like I said, it's almost 100% certainty that you're using one of their
Yeah,
products.
yeah, and they'll have over 1 billion users of their WeChat app, which WeChat is, for people who don't know, is a super app. I mean, it would combine things like Facebook and Netflix and payments all into one app. And companies in China don't create, like if you had a retail business in China, you don't create your own app. You just create a page on WeChat because there's no point in you creating your own app. It's WeChat is that present in everyday lives that everybody just has to do business through them, and that's huge. That's a huge advantage, and we're just now starting to see the monetization of that. But there is huge potential there.
Absolutely. And let's move to Alibaba. Very similar business here. Many consider it to be the Amazon of China. We've seen exceptional results from them over the past year, with both from an operations perspective as well as its share price and the appreciation we've seen. Most recently, we've heard a lot about their cloud business and the growth that they're seeing there, along with a highly anticipated IPO of Ant Financial, a partly owned financial subsidiary that they own. If you could share a little more in detail, why we think Alibaba is such a terrific business to own, and one we think we will continue to own and compound our wealth over the years, and ultimately, why the Alibaba or the Amazon of China may be a better investment than Amazon itself.
Yeah, and I mean, obviously, I think it's a better investment given today's prices than Amazon. And there's a few reasons why I think that. I mean, if you just compare them as e-commerce companies, which a lot of people think of Amazon as like I go online and I buy stuff and it gets delivered to my house, and that's what Amazon does. And that's true. That is a big part of what they do, and most of their revenue is generated from that. And Alibaba would be the same. But if you compare them, Amazon is selling a lot of their own products. They have their own warehouses. They are selling Amazon branded stuff. They hold inventory. This is a different business model than what Alibaba does. Alibaba only sells third-party stuff. So if you are, say, Nike, and you want to do sales in China, well, you don't create your own e-commerce store. You go through Alibaba.
Yep.
So you could buy Nike products. And the way Alibaba makes money is they either charge you a commission on that sale, or they sell advertising on the Alibaba apps that they have, either Taobao or Tmall. That is a much more profitable model than the way Amazon does it, because they don't have to hold inventory. There's all kinds of costs of having warehouses.
I was going to say the
and
capital investment in the warehouse.
huge capital investment cost. So Amazon is actually moving more towards an Alibaba type of model. They are having more third-party sales, but they already have sunk so many billions of dollars into their network, and they're not going to be able to completely move away from that. So, as an e-commerce company, Alibaba much more profitable. Also, I think they have much higher growth and arguably more potential to grow.
You referenced the cloud there, and you talked about Amazon and how e-commerce is obviously what we know them for, but that's not the sole thing that they do. And maybe you can talk a little bit about that and why that's important when we're discussing Alibaba.
Yeah, for sure. Again, so Amazon is an e-commerce company, but if you look at their actual income, their net income that they make, their profits, they derive about 2/3 of their profit from the cloud business.
I think we even have a chart here.
Yeah, so if you look at that chart, you see a lot of the revenue, or the majority of their revenue, comes from e-commerce, but really their profits are coming from cloud. And it's quite dramatic because only about 10 to 12% of their sales are the cloud business, but 60% of the profit comes from there. So it's a much more profitable business. And that just underscores, like, Amazon is far and away the biggest cloud company in the world based on revenue. But cloud is just at the like embryonic stages. Cloud is going to be a massive shift for businesses all over the world, and there's a huge opportunity for a company like Alibaba, who they're quite a bit smaller than Amazon's cloud business if you look globally, but in China, Alibaba dominates. They have about 2/3 of the market, and they're starting to actually get profitable, which is crazy because they are plowing billions of dollars of investment
And a
into
lot profitable sooner than they had expected, or analysts had expected. 2021, I believe the announcement was that they believe
Yeah.
that.
Yeah, they expect to be profitable this year, which is much quicker than I would have expected. And that just, what that says to me is that they cannot actually invest fast enough to push themselves into a loss, which means that they're starting to achieve escape velocity on their cloud business. And if you compare the metrics of Amazon and now you apply those same metrics to Alibaba's potential, well, like,
Yeah.
it's huge. It's
Yeah.
just, if Amazon is a $1.5 trillion to $2 trillion company, there's no reason that Alibaba couldn't also be in that same range, and that would mean that the company would pretty much double in market value. So
Something we want to own.
yeah, absolutely.
Next company that we're excited to talk about, and it's worth discussing. It's a new business in our portfolio, so we're excited to talk about it here. However, it's not likely a new business to many of the viewers that are watching, and that company's Spotify. The pandemic has had a very little effect on their business, and possibly even helped their business during this time. We saw a recent announcement of the world's most popular podcast, the Joe Rogan Show, becoming a Spotify exclusive. Also very exciting news for the company. Would love for viewers to hear your thoughts on Spotify, and I know we've discussed this, but why you believe they're en route to becoming essentially the Netflix of audio.
Yeah, for sure. And I think the Spotify investment. Spotify is a company that they're much more. Whereas Tencent and Alibaba have a variety of different businesses, Spotify is much more focused in what they're doing, but they still are similar in the sense that they are creating a platform, and the strength of those businesses all comes from their platforms and their ability to keep people's attention. And if you want to compare it to a company like Netflix, which everybody knows and has done very well this year in pandemic, Netflix is all about keeping your eyeballs. They want your attention, and they make money from selling subscriptions, but they have to keep your eyeballs' attention in order to keep those subscription money going. Spotify is the exact same model, except they're going after our ears, not our eyes. And they're really the only company in the world, or at least in North America, that, or the West, I would say, that is exclusively going after our ears. They're focusing on audio content, and I think the Joe Rogan deal is a huge coup for them. Joe Rogan's got a massive following. 200 million people download his podcast every month.
Insane number.
It's an insane amount of people, and now they're going to have to go to Spotify to do that because it's going to be exclusive, and that's a huge boon for them. If you look at the market share, and we've got a chart of music streaming, it's still a competitive market. They have competitors. Apple obviously is a big player. Google and Amazon are definitely trying to grow that business. But Spotify is clearly the market leader. And if you look at their competitive statistics versus Apple on subscriptions,
Who's number two?
Who's number two
in the space?
They're dominating Apple, and the reason that they're dominating them, and I think we have a chart for that. The reason that they're dominating them is that their app is better because they're more focused on what they're on just audio.
Yep.
Apple's got a lot of balls in the air, so they're focusing on iPhones and Apple TV and services business. They got a lot of things to mind. Spotify only has one thing, and that's a huge advantage, I think. And I think that Spotify's really got the right dynamic strategy to grow their business.
I know we've talked about it here in the office, and I think it's worth talking about for viewers, and it comes back to the advertising. And I know Spotify has made some very interesting acquisitions and have some interesting plans in helping essentially people create content, but as well helping advertisers push advertisements out to people in a very focused and very focused manner, like a company like Facebook, where they have so much data that you can really target your ads. Maybe you could share a little bit more about some of the discussions we've had there.
Yeah, I think Spotify has done advertising since the beginning. So there's always it's a freemium model, so you can pay for no advertising, or you can just listen on an advertising basis. But they haven't really monetized their advertising very well, and they haven't really developed the algorithms that a Facebook or YouTube, maybe even a better example, that they've developed, but they're now starting to get there, and that is a huge potential again. They've got the ears, they have the users, they've got the subscribers. Now they have to figure out a way to monetize those people, and they're going to continue to accumulate those people because they're signing Joe Rogan, and they're signing Michelle Obama, and they're signing Kim Kardashian. All of these people are going to do podcasts with them. So user growth is not going to be an issue, or at least I don't think it will be an issue. But now they have to figure out a way that for the people who don't want to pay for a subscription, how are we going to monetize them? And the advertising model is a big part of that, and it's a focus. And I think they're making strides.
Again, another wonderful company, capital light compounder that we want to own, and something that we intend to own for many years. So excited to have added that to the portfolio. And I think it's always exciting when we add names to the portfolio that consumers have a connection to and investors have a connection to, because they can understand it. They go, I own a piece of this. So obviously we don't invest in companies for that reason alone, but it's always nice when we're talking to clients and they understand the products that and companies that we've bought into. So
yeah, absolutely.
With that, we're going to go to a company that it's a business that many are unaware of. Before we kind of get into it here, just wanted to reference the trend that we've seen in e-commerce during the pandemic. We've seen a lot of businesses benefit from the pandemic in that e-commerce space and pulling a lot of that growth forward. The company that we're talking about today is Sea Limited. It's a name that we've added recently. Like I said, most people are not likely familiar with this company. But not only, so Sea, you can share a little bit more about Sea, but they're an e-commerce business, but they're not just an e-commerce business. They have some exposure to other things like gaming industries, which are notoriously known for their ability to generate cash flow, the successful ones anyways. So if you could walk us through Sea Limited and ultimately what makes it one of the most promising investments that investors have never heard of. Yeah,
for sure. So if you haven't sensed it yet, I mean, you're going to see a common theme in a lot of our investments, and I mean that goes back to basic principles. Warren Buffett says, invest in what you know, and invest in businesses we can understand. And Sea is a model of a business that's very similar to an Alibaba model. So it's a model that we're familiar with, and Sea stands for Southeast Asia, and that's where they do their business. They're based in Singapore. But they do business in a number of Southeast Asian countries, Vietnam, Malaysia, Indonesia, Taiwan, the Philippines, places like this. And those areas are underdeveloped, but they're growing rapidly, and they are a huge population base. So there's about 600 million people in this region, and that's growing rapidly. And you know, if you look at just the Philippines or Indonesia as an example, those are all going to be those are both going to be countries that are in the top 10 biggest countries in the world for population.
Yep.
And so these are huge markets and huge potential there. And Sea is really the market leader in e-commerce in this area. Their main competitor is actually an Alibaba subsidiary. So we have got both sides of the competition there. But Sea has really, with their Shopee app, has really dominated in the last couple of years. And you know, it's, like I said, a huge potential, a great model, growing very fast. But you're right, though, they do the e-commerce model, but they also have a video gaming franchise called Garena, and they've had a runaway hit that they developed called Free Fire. It's not as popular in North America, but it is very popular in places like India, Latin America, and Southeast Asia.
Essentially, another battle royale game that
Yep.
very similar to a Fortnite
Yep.
or a PUBG, if North Americans are familiar with those.
Yeah, and the funny thing is like as not as familiar as people are with Fortnite, people who've never played Fortnite know about it, but Free Fire actually has more users than Fortnite does right now. So it speaks to the sheer size of the markets that they're in.
Yeah.
But also just like it's a great game, and I didn't talk about it with Tencent, but gaming is going to be another area of media where, you know, we've talked about Spotify with the audio, we've talked about Netflix with the video. Gaming is going to be a third leg in the entertainment.
It's huge.
And if it's not already, it's going to be. And
It's on its way. We've seen tremendous amount. I know we were talking about Twitch the other day, you know, gaming, essentially where gamers go to stream, and the amount of hours that people, the eyeballs, that attention that you talk about,
Yeah.
it's massive.
Yeah, and you know, we're seeing in North America, Amazon's coming up with their own gaming platform, Google's coming up with their own gaming platform, Facebook, you know, Microsoft already has a gaming platform for a long time. All these technology companies want to get in on this space, and the Tencents of the world and now Seas of the world, they don't have a lot of competition in their markets, so they don't have to worry about, you know, Alphabet coming in or you know, even Amazon coming in and eating their lunch. So that's a huge advantage, and I just think there's massive potential there.
Absolutely. We're going to shift a little some gears here, and you know, talking a lot about tech and gaming, e-commerce. Power Corporation of Canada, which continues to be one of the largest positions we've had in our portfolio. We've seen a number of positive developments with this company over the past year and over this quarter. One of which has been the continued growth of the robo-advisor platform Wealthsimple, which I don't think a lot of people even necessarily understand that this is now a Power Corporation of Canada business. So with them owning robo-advisors, but also being in financial services, can Power Corp be seen as an investment into fintech without the major risk that comes with investing in startups in the fintech space?
Yeah, I think to some extent it can be. I mean, if you look at Power Corp, its two main businesses are Canada Life, formerly Great-West Life, and Investors Group, and those are by far their biggest revenue generators and their biggest profit generators. But they also have all these a lot of these fintech projects and different you know, growth companies, subsidiaries of theirs, and you know, when they invested in Wealthsimple originally, I know that their strategy was that, yes, this might cannibalize some of our Investors Group business, but if we don't do this, somebody else will, and we want to. If somebody's going to come in and destroy our business, we want to be that person. And I think that's essentially what they've done with Wealthsimple. I mean, it's grown from a startup to now a company that's valued at over $1 billion, and growing very rapidly, especially during COVID. Their growth has been phenomenal.
Raised their dividend mid-pandemic as well.
Yeah, Power Corp, the parent company, did, but just in simple
Okay.
terms, their number of accounts that they've added is like up 20% in the last 6 months or something crazy like that. So it's that simple platform has really taken off, and I think it's going to continue to grow. And they just did another raise of money, actually with exterior investors, but just shows the strength of the model and huge potential there. And Power Corp as a whole, I mean, it's just a very strong, stable company, and a great dividend, as you mentioned. But really, for me, the amount of free cash flow that they generate, the amount of profit that they generate, relative to the price that we have to pay to to buy a share, it's just very compelling to me. And I don't think it's going to be. Power Corp's never going to grow at rates like you'll see from an Alibaba or a Tencent or even a Spotify, let's say. But it doesn't have to grow all that fast for us to get a great return on it.
So that's why we own it. One of the last areas we're going to talk about today, the Canadian economy has ultimately lagged a lot of other economies around the world since the slump in oil prices back originally in 2015. We're seeing continued headwinds from things like government policy, climate activism, now economic shutdowns, which really threw oil prices for a ride early in the pandemic there. But I think even more worrisome to some anyways is this trend towards the belief that renewables will soon replace oil and gas, placing many of these businesses at risk. So in your eyes, are energy companies still a good investment today?
Yeah, so I think they can be, and obviously we own some. I think you have to be very careful. A lot of the things that are in the media about the oil and gas industry are true. There is going to be more renewables going forward. There's already, the economics of power generation by coal is already, that's a dead business as far as I'm concerned. It's going, those coal jobs are going away because they're being replaced by either natural gas or solar, frankly, which is less costly and better for the environment. So there's really no case to be made there. But I think it might be a little bit overblown, some of the coverage. We definitely have seen a drop in demand because of COVID, and we have a chart, I think, that shows the oil demand and supply over time, and it's a pretty interesting chart because the growth in demand is pretty steady. Like, for all of the volatility in oil prices, the actual demand for it has grown pretty steadily over the last 20 years, and I don't think that trend is going to reverse all that dramatically in the next few years. I think it will eventually plateau and will start to decrease. But the idea that we're going to go from 100 million barrels a day of consumption to like 75 million barrels a day, that's not realistic. That's not going to happen. And if you look at that chart, a lot of the supply that's been added over the last 10 years, let's say, a lot of it's been shale production in places like the United States, which is much more unstable from a geological standpoint, because when you drill a well, the rate of production on that well is going to decline much more rapidly with a shale play than it would with the traditional conventional well. And what that means is you need a constant flow of new money coming in to drill new wells. And either that money is either going to be generated from the business itself, which when prices are at $40 a barrel, you're not generating cash to drill new wells. And if you can't do that, you either have to borrow money, which is also not happening, or you can go into the market and issue new shares, which again is not very realistic at this particular point in time. So there's no new money to drill new wells in the US, or Canada for that matter. And so what we're seeing is that the production is coming down. Now, it's coming down maybe slowly to start, but it's going to start to dramatically drop. And so I think that there is a crunch point where the supply is actually going to reduce faster than the demand will reduce. And I think we're going to see that over the next couple of years. Now, I still think, like I said at the outset, you have to be careful
I was gonna
because
say what like when we're looking at oil and gas companies and you know everything you're saying, I'm going whoa, or people are likely going, well, why would I want to go invest in an oil and gas company? So what is it when you are
Yeah.
looking to put some money in this space? What are you looking for, and what ultimately do you want to see in the businesses that you're investing in?
yeah, and so like with anything that we do, we want to own quality. So I think we've identified a couple of companies that are just of the the top quality. Canadian Natural Resources is probably the premier quality oil and gas company in Canada, and the other one we own is Whitecap. And if you look at those two businesses, what they've done over the last 6 months during all this turmoil, you know, they've still have maintained dividends. So Whitecap did drop theirs, but you know they still have a very strong dividend. They've allocated capital very well, meaning that they're not in survival mode. They are in, you know, predatory acquisition mode because they see all of their competitors are getting absolutely demolished by these low oil prices. So, you know, what they've done is they've made acquisitions, and particularly with Whitecap, you know, they added or they made an acquisition of a company called NAL Resources, which adds about 20 to 25 to 30% more production to Whitecap's business, and they didn't have to take on any additional debt to do that. So essentially what they've done by doing that is they've deleveraged and de-risked their business. And the other attribute that I really like about these two companies is that they are the low-cost producers. So if you look at Canadian Natural, you know, they can be profitable at about $30 a barrel WTI price. And Whitecap's not quite as good, but they're still, you know, they can be profitable at about $40 WTI price. So they're profitable even at the current price where it's at. You know, they're not going to be growing rapidly at that price, but you know, they can pay their dividend. They can turn the lights on. They can keep their production going. There's just a lot of companies that are not in that fortunate of a state, and you're going to see a lot of bankruptcies. You're going to see a lot of consolidation in the industry. We're already seeing it. So, you know, when you own quality like this, I think there's definitely potential there because if we do see a supply crunch, even if that supply crunch comes 2-3 years down the road, you know, the price of what we're paying today for, you know, say we're paying $2.70 for a Whitecap share today, that could easily be $5. It could be more than that. So I definitely think that there's opportunity there. And in the meantime, we get paid 6-7% dividend yield just to wait for that.
Yeah.
So I mean, again, I think the risk is lower and the opportunity is very high. So I think it's a great bet.
A little bit of heads I win, tails I don't lose much in this case. So
yeah, and I think, you know, again, going back to basic principles, that's what we're trying to do. What we're trying to create is we're trying to create what I call asymmetric bets, where if we're wrong, we lose a little bit, or maybe we break even, and if we're right, you know, we're going to make 4, 5, 6 times our money. And these are the types of companies where I think that we have that asymmetry to the bet, because I think if we're wrong and oil prices stay low, you know, okay, so we may collect our dividend for a few years, the price doesn't go anywhere. They're not going out of business anytime soon, either of these companies. Both of them are well capitalized, and so they're not going anywhere. And if we're right, and oil even goes back to, you know, the mid-60s, which is where it was at the start of the year.
Tremendous share price appreciation.
Yeah, we're going to see huge gains, and it's going to be a very exciting time for the management of those companies because they're going to be having all kinds of great decisions on where to allocate that capital in the future. So,
Great. Well, with that, that really was the last business that we were going to talk about today. Obviously, there's more in the portfolio, but so we'll close it off today. Please, give us a follow. Check us out. We're on Facebook, LinkedIn, YouTube. You can check out our website, www.endeavorwealth.ca. We have a lot of this video content there, as well as blogs. Really focus on ensuring that people are getting good financial education, whether it's personal finance to investing. So lots of great content there to check out. For anyone who may be needing a second opinion on portfolios or any of the planning work, I know we're always willing to sit down and give you our thoughts and again, a second opinion on what you're currently doing and see if there's anything that we can help with at that time. So thank you, Craig, so much for coming and talking about the businesses that we own and sharing a little bit about what we're seeing in the markets there. And appreciate everyone else for tuning in today.